Okay, so what I'm going to do here is I'm just going to give you a quick thumbnail of what we're going to cover in the course and why we need to do this. I want to spend the next half hour or so convincing you that we need to change the way we do auditing and accounting. Okay, so the first thing is that my thing's not working here. First thing is that we want to. Okay, all right. Okay. In anything, the only reason we do auditing of any kind is because there's certain risks involved. Okay, so we always start in auditing with we have risks, objectives, assertions, and then we add controls to that. Okay, so we want to start with risks. So, do you see any risks in this picture here? Do you see anything in that picture that looks like a risk to you? Anybody? Yeah.
They're pretty close to each other, so what is it?
Yeah, they're in a bike race and they're pretty close. Yeah, absolutely. Anything else? Yeah. The speed, they're going fast. Okay, so there's risks in life. Okay, but did you also notice here that this bike has no back tire on it? Okay, so that's a risk as well. All right, there's no back tire in that bike. So everywhere we go in auditing, we're addressing risks. Okay, and we always start with what are the risks, and we only address things that have risks. Okay, I'm a risk officer, and we say in our business there's nothing that we do that isn't, if something is not a risk to our business, we shouldn't be managing it. Okay, whether it's a compliance risk, a strategic risk, a financial risk, whatever. We only deal with things that are risk to our business. Right? All right. So why does auditing need to change? Okay. Well, here's some of the reasons. Right. And I talked about some of these. I don't know why my thing's not working here. Oh, there we go. Okay, so we have a lot of excessive audit and compliance costs. To field a group of, in a Fortune 5 company, to field a group of 400 auditors, they say average you have about one auditor for every 1,000 people in a company. So if you have 400 auditors, it probably costs you $20 million a year to field those auditors. It's very expensive. And the travel is very expensive. I found myself approving people who made $150,000 with $250,000 in travel and expense costs around doing auditing. So very expensive. Unnecessary risk and fraud. Most controls are monitored manually. We talked about that. Critical controls go untested. We have a serious latency in what we do in auditing today because we're not looking at stuff. We go in and audit manufacturing plants or organizations once every other year because we don't have the resources to audit them more frequently. CFOs sign off on financial information with imperfect information. I just read a great article from Andy Fasto. Everyone know who Andy is? Smartest guys in the room. Enron. And he's out now of jail, and he's going around. He spoke at the ACFE. By the way, I'm a certified fraud examiner too. I encourage you to do that, maybe ACFE, CFE certification. But he was saying how he was signing off on things that he knew were wrong, but he felt the pressure to do what everyone was telling him to do, including the CEO of the company. And many of you, the other question I always ask people in an interview is, tell me about a specific time, Jennifer, that you were told or asked to do something that was wrong, whether it was in school, in a class, or in a job that you had, and how did you respond to that? And what I look for there is I look for people who are willing to stand alone, people who are willing to stand up and say, I was asked to change these numbers or do this, and I didn't do it. And interestingly, 3/4 of the people who do that lose their jobs. Whistleblowers lose their jobs, 3/4 of them. So it's kind of a tough situation you're in. You have a family, you're feeding your family, you're trying to do your job, and you're going to lose your job if you do the right thing. Kind of a sad state. So excessive audit and compliance costs, unnecessary fraud, wasted time and effort, and inefficient business processes. Okay, that's part of why we need to do things differently. And despite Sarbanes-Oxley, despite all the things that have happened, everyone knows what Sarbanes-Oxley is, right? 2002, signed by President Bush, an act to improve financial reporting and prevent the disasters of Enron, WorldCom, and all the others. But what happens? They're still happening every day. There's somebody else that's cooking the books, or whether it's a bank or a financial institution or a manufacturing organization or a nonprofit, it's still happening, okay? So, a couple of other reasons, and I want to get your attention with this, of why we need to change. One is that we have issues with latency, okay? We're finding things way after they happen, and, you know, and often the statute of limitations expires before we even get to prosecute someone who does do something wrong. I mentioned earlier, auditors like you guys are often expensive middleware. You're just, you know, you're just transferring data from this Excel spreadsheet to this, and in a day when we have technology that we can move data anyway. So if you find yourself in that situation where someone's saying, Matthew, take this data from here and move it into this spreadsheet, you ought to say, why am I doing that? Why did I go get my MBA in order to be expensive middleware? Okay? I hope you'll help change that, because it's totally unnecessary. You can pull data out of any system and normalize it and bring it into any other system, and we shouldn't be middleware. Okay, so whenever you find yourself doing that, and you'll do a lot of it today, I promise you. Okay. Okay. Now think about this. We're taking. We said this earlier. We're taking a non-statistical sample in many cases, and actually in most cases. So we're taking a sample of 30. If you look at the guidelines from the big 4 firms or internal audit guidelines, they say if you have a continuous process that happens every day, accounts payable, accounts receivable, payroll, then take a sample of 30, irregardless of what the population is, and we're going to find fraud. Totally inadequate. And the only reason we're doing that is because if we took a statistical sample, which I believe in with confidence levels, we'd have to take huge samples, and we wouldn't have auditors to do it. We couldn't hire enough auditors to do it. And so my contention is, let's skip that process. So what we're doing is we're really not even using statistics, and we're thinking we're finding stuff. And being on the other side, if you're in a corporation, you know that. You know when they come in and look at the T&E expense, that in a company of 380,000 people, all, you know, with travel expense reports, they're only going to look at 30 to determine if we have fraud going on. So what are you going to do? You know, if you're cheating on your expense report, you're probably going to say, well, there's a really small chance that anyone's going to find this, you know, and so I'm going to keep doing it. Okay, and you know, because you will never stop fraud, because the people who perpetrate the most fraud in companies are C-level executives and accountants like you, because you know when the auditors are coming, you know they're only doing a sample of 30 out of a population of X thousand, okay? And so you have, in the fraud triangle, you have opportunity. You may have a motivation because they're not paying you enough, or they're not paying you as much as your buddy in New York who's making 100,000 more than you are, and you have rationalization. I'm working 12 hours a day, 6 days a week, I deserve this, okay? So, but the key point is that, you know, this is inadequate, and it's unnecessary in this day and age. If it was 35, 40 years ago when we didn't have any data, we were doing everything manually, yeah, this was the only way to do it. I have no problem. You know. Okay, now, if you think that, well, you know, I'm going to work for Ernst & Young or Deloitte & Touche, and, you know, you know, we're professional, it's a professional organization. Again, I'm not being critical of any organization, I want to be clear, including Siemens or whatever, but I'm just saying, I want to prove to you that this is inadequate. Do you know who audits the audit firms? PCAOB, right? So here's the report, one of the reports from the PCAOB. I'll keep it anonymous, but it doesn't matter because they're all this scathing. I don't know if you've ever seen these before, but they're available as public documents, okay? So this is a review of 51 engagements done by one of the big 4 audit firms, okay, who will remain unnamed. And this is the review of the PCAOB on how they did it, okay? Okay, so let me read a few of these. The firm failed to sufficiently test the issuer's assertions on key topics such as multiple element arrangements. You know what they are? That's where you have software and companies and you're doing multiple element, which is a key hot button from the prior year. Now this isn't that it wasn't good enough. This says that they materially, or the firm failed. The firm failed. In this audit, the firm failed in following respects to obtain sufficient appropriate. This is on all of these 51 samples, and they're doing sampling too. God knows what they find if they did every company. The audit firm failed in the following respect to obtain sufficient appropriate evidence to support its audit opinions on the financial statements and the effectiveness of ICFR, internal controls for financial reporting. They failed. Not it wasn't good enough or it could have been better, but they failed. The firm failed to test completeness of certain system-generated data and reports it used to controls and substantive testing related to inventory and sales revenue. The firm failed to perform tests of details that were specifically responsive to the risk of fraud it had identified related to reserves for sales discount allowances. The firm failed to sufficiently test certain controls over accounting for certain of the issuer's investments. The firm failed to sufficiently test controls over the valuation of deferred tax assets and the accounting for and disclosure of variable interest entities. The firm selected for testing controls that included the review of journal entries, but the firm's procedures did not include testing of the effectiveness of those entries. The firm's tests of certain review controls over revenue, deferred revenue, accounts receivable were insufficient. This is not, and it goes on, the firm failed, the firm failed, the firm failed. I mean, this is the most scathing audit report I've ever seen. You know, usually we throw a few bones and say, you know, the management was cooperative and they worked with us. You know, this is the PCAOB doing the firm. And look at them every year, and look at any firm. I'm not picking on the big four, and it's the same reports. Now, the PCAOB is not doing, in my view, a great job of, you know, and we're trying to get them to come here and speak at Rutgers, you know, in these symposiums that we do in November. By the way, I encourage all you to come to that. In November, we have a symposium here on continuous auditing and reporting that they host here at Rutgers, and we have people from all over the world, including the firms here. But this is saying that the people that are monitoring what we're doing are also saying that what we're doing is inadequate. Okay? So, very important. Then, okay, the next topic, the reason what we're doing is inadequate. This is the 2016 ACFE report to the nations. Okay, and it's based on several thousand actual cases, and it's updated each year of fraud that were found. And it estimates that fraud is 5% of revenue in the average company, or 5% of budget in a public, you know, in a state or federal agency or nonprofit. So, you know, I work for a company that's a $100 billion company. That means we lose 5% of revenue to fraud, and that's everything from stealing paper clips to Enron type things. Okay, now just think about that: 5% of revenue. So your parents own an entrepreneurial shop that has makes $1 million in sales. You know, they're losing 5% of that to some type of fraud. And I'm telling you, fraud is so pervasive, and it's going on everywhere, and everybody advocates in the accounting world, SAS 99 and other things. We say, oh, it's not our job to find fraud. Well, whose job is it to find fraud if we're not going to find fraud? And if you think about this, also 52%, based in this study, of actual fraud cases, 52% of the frauds were collusive. And almost all financial fraud from past reports is collusive. You know what collusive means? That means that Peter and Matt are in on this together, and they're working this together. Okay? And if you have collusive fraud, all our control, our entire control environment is based on what? What did you learn? On four eyes principle, right? So I'm trying to find collusive fraud using 4 eyes principle. I'll never find it. And the only way to find collusive fraud is to create a perception of monitoring. Okay? And that means that someone's watching everything I'm doing. So as an example, you know, I work for a company where we monitor everywhere someone goes on the internet using technology. There's that technology that says if Jennifer goes to this website, then send us an alert and we're going to deal with it. Or if she goes to these types of websites more than 5 times, send me an alert, whatever the analytic is. And it could be whatever you want it to be. Okay? So I have no temptation to, you know, look at porn on my computer here or start running a separate business outside of Siemens, because I know I'm going to get called. And so now my opportunity for fraud is gone. But if I know all we're doing is sampling 5%, you know, or a sample of 30 out of thousands of people doing websites all day long, I'd take my chances. Most people would, and that's unfortunate, but that's the truth. Yeah.
Would you say that it's mostly just the illusion of creating the monitoring, or is it actually monitoring that? Because you say that if you tell, like, if everyone knows only half of what they actually think is being monitored is monitored, but they just can't tell what is being monitored, would they still perpetrate, or is it kind of?
Yeah, well, the reason I say perception is that, this is a great question. The reason I say perception is that, I want to create a perception, whether or not I'm doing it all the time. It's like your ADT security thing in your window. It tells you that there's a system in that window. Some people put the label on the window, but they don't really have an ADT system, and that can be a deterrent too. What we want to do is, in the fraud triangle, we want to take away the opportunity, because people that believe that have an opportunity, have rationale, and have motive are going to commit fraud. And these are not scumbags. And I've been involved in fraud investigations and we found fraud things. And unfortunately, today, only 3% of the frauds that are found in America or in the US are found by external auditors. 14% are found by internal auditors. And most of the ones that are found, and understand, we're finding very few of them. Okay, we're woefully inadequate what we're doing. We're not finding that 5% of those frauds. And by the way, if you did find them, what would happen? That 5% of revenue flows right to your bottom line and doesn't cost you $1. If you sell something, you got to sell $1.35 or $1.50 to make $1. If you find fraud, it's free if you can prevent it. Not to mention that you have a company that has integrity again. But we're not finding the frauds. And an example, one thing I was brought in afterwards in the IT audit practice was an employee who stole $350,000 from our company. And what the employee did was they didn't have and it was an 18-year employee that was doing fraud investigation work for the legal department. And what they did is they had a travel card, like we all have, that we travel with, and you'll get one when you start in your company. And they were the liaison between the U.S. bank or the bank and the company. And all they did was, when there was a kickback, and that's a legitimate kickback, if you use certain volumes on these cards, they give you a kickback, or a return, or a wrong transaction, the bank would say, where do you want me to charge that to give you the credit back to? And the individual just said, oh, just give it to account 1393933 to this account. So they credited back to that person's card account instead of to an account. And there was no control on that because it was money coming into the company. It wasn't, the person wasn't traveling. If the person traveled and bought a cup of coffee, that would have to be approved by a manager. So what they did is they just had it brought back to their card, and they went to an ATM machine and took the money. And only got caught, interestingly, I'd like to say we found it, but we didn't, only got caught because they had to train somebody to do their job when they were away on vacation. And they got very upset that they had to train this person, and they treated the person like crap. And then when they finally did go out on vacation, the person was so upset about it that they started digging into their files and found the fraud, and that's how it found. But I'll tell you right now, most of those are not found, and they're going on every day here at Rutgers, in the companies you're going to work for, in the firms, okay? And it's all kinds of things. It's everything from people playing solitaire to looking at porn to not working to doing earnings management. And understand too, when we talk about opportunities, some of them, and motive, some of the motive is very, very benevolent. So for example, the people you guys are going to work with, you're going to spend more time with than the people you live with, your spouses, girlfriends, boyfriends, whoever. And so if I'm doing earnings management, if I'm going to mess with provisions on the balance sheet or the income statement in order to keep us solvent and not cause a panic in our stock to drop, who am I doing that for? I'm doing that for you guys. You're my friends. I'm helping keep your jobs. And it's going to come back next year or next quarter. We'll be all right next quarter. So I'll just adjust. That's what Fasto did. He just adjusted through special purpose entities, taking off balance sheet transactions to make the company look good for another quarter until the energy market recovered, and then they were going to be fine. So I'm doing that for you. I love you guys. I'm not a scumbag. I'm not trying to pad my pockets. I just want you not to lose your job, Peter, because you're my buddy. We play golf on the weekends. So that's the kind of rationale. And you know, and what's happening is we're assuming with all our whole control environment that all the controls, that there's no such thing as collusion. So we have 4 eyes principle. So if you approve the purchase order, you assign the payment. No problem. Well, what if these two guys get together and say, this sucks, we're getting ripped off here, you know? And the rationale is the kinds of things, you know, I'm doing, the same job you're doing, Ming, and you're getting paid $100,000 more than me, so I'm just taking the money I deserve. Or my grandmother is dying of cancer and she has no medical coverage, so I'm gonna pay it back to the company. You know, it's this kind of rationalization that happens. But the point is that if you have non-statistical sampling and you have 4 eyes principle on all controls, and most proven from this report, this is empirical data on fraud, by the way, and we're going to cover this in class. This is not just somebody's estimates. You know that almost all financial fraud is collusive. Then this is inaccurate. It's not finding this stuff. And the worst thing is the people that know that the best are you guys, because you're the accountants. You know how it's done. You know. That's why C-level executives in accounting are the biggest perpetrators. Good comment. Any other thoughts on that or questions about that? Again, I'm trying to convince you that what we're doing is not adequate. And I'm not disparaging anything that we're doing today in the sense that it's tradition, we're doing what we did, but I'm trying to impress upon you the urgency that we need to change. Something needs to change. And you need to be the energy to help change that. Okay, that's the point, all right? Are you following with me? So these are some key reasons, could be on the exam, of why what we're doing is inadequate, and there's others, okay? So then you have this whole topic of independence, okay? So what's the biggest conflict of interest in the world? I'm gonna pay, I'm a big Fortune 5 company and I'm paying $50 million to a company to find me doing stuff wrong, right? So, that's kind of a conflict of interest, right? So I'm paying you $50 million and I want you to tell me when I'm doing something wrong. And so this is just a little, to the best of my knowledge, which is pretty poor, and maybe revised, my company accounts are more or less accurate. I've checked this with my auditors and directors who I pay to agree with me. And that is a problem. That is an independence issue, that we're, and that's why I think the best thing we can do is have a good internal control process. And controls belong to the management of the company. They do not belong, they're not the responsibility of the internal auditors, they're not the responsibility of the external auditors. They provide independent, supposedly, reviews. But you can have a control environment that is, secure, and that makes everyone's job easier. But again, we're in this thing where we love to, everyone wants to make money from this. So and it's expensive, it probably costs $200,000 to field an auditor, yes.
My question was regarding what you said about the PCAOB agreeing that the current system is inadequate.
Yeah.
Even if the big 4 firms or all the firms are willing to accept that the way they're doing it is inadequate and switch it over to more of an analytics method, is the PCAOB going to accept that as an okay way to audit?
Yeah, that's a great question and a great point. And I think the answer to that is right now, in my view, we are recording this, right? The PC, I'm not getting in trouble for this, but the PCAOB, a lot of times, is not providing direction for the future. They're only bashing what's going on now. And a lot of them were that are on the PCAOB are former auditors that ought to know that what we're doing is inadequate, and they have not been pushing, in my view, and we have invited them here to Rutgers for this worldwide seminar. They have not been pushing to go in this direction. And I hope they would accept it. But we'll talk about this in the class too, that one of the things that we've had a challenge with at Siemens and other places is when we start using analytics, the big 4 firms and our auditing firms aren't sure how to deal with that in some cases. So for example, we have a system in our financial services group that monitors leasing transactions, every transaction, and I'll share some about it. It's a really cool system. And it's all done with analytics. It's got, and this is a real important concept in this class, it's got closed loop escalated alerting. Write that down. Closed loop escalated alerting. And I'm going to talk about this throughout the class. What that means is that just having information that someone, do put your name tags up. I want to get your names here. That Joshua, just having information that Joshua did something wrong or might be doing something wrong and sending an email to Joshua even is not a control. because then I haven't.
Anything popular Trump?
Sorry. What is it? It's not a control, because all I'm doing is I'm just gathering information, and with a lot of these systems we put them in and we just send people warnings and we say, you know, Peter, you shouldn't be doing this, or, you know, and what we really need to do is have a closed loop alert that says, if I find an anomaly, Joshua doing something wrong or not correctly, because these can be mistakes as well as fraud. It's not, everything's not a fraud. A lot of people, Mikolos estimates that if 5% of revenue is because of fraud, another 5% is because of mistakes. And people just don't do the right thing, don't follow the process. So if I just create information from these and don't do anything about it in a closed loop way, then I don't have a control. And also the system that you use, whether it's ACL or another system, needs to be accredited so you know that someone isn't messing with the system that's finding the problems. And accredited means IT general controls. Things like change management is solid, systems development is solid, computer operations, wherever the server is for this, is solid, and upgrades and things into the system. That those things are secure. So closed loop escalated alerting is that I actually create a control, and you can't get out of fixing this thing, Joshua, and unless you fix it. And if you don't fix it, it's going to escalate up to your boss and to the CFO of the company. And we have a system at Siemens like that, where if people don't fix a control problem, it's going to be on the CFO's desk in 5 weeks, and he's going to deal with it. Now I have a control. But we had the problem where the auditing firms come in and say, oh, you guys have you have this automated thing. That's really cool. We'll do that, and now we want you to do a sample of 30 too. And I'm like, wait a minute, we just tested the entire population, or a sample of 1 for an IT application control. We just tested the entire population, and you want us to go take a sample of 30 too? No, why would you do that? I have the whole population documented, every transaction, and that it's clean or not, and you want me to go take a sample too? And I'm like, and we had these arguments. So we have to change the auditing standards, and the AICPA knows about that, and they're working on that too. That we got to change the auditing standards, so now we don't take any samples. Why would we take a sample if we did the population? What we do need to do is make sure that this system that you have that's doing the monitoring was operating during the time of exposure. So during the year, it operated the whole time. And I can prove that with daily reports that show that. Also, if there were management overrides, if someone says, well, this thing is okay because you're a special employee and you're allowed to do this, then we document that management override, okay? And that the design of the control, what it's monitoring, actually reflects the process, and that's a once-a-year review. So as long as those things are happening, I don't do any testing. And this is what scares auditors and scares people, is they say, oh my gosh, I'm not gonna have a job because there's nothing for me to do when you put this in. But that's not true. Now Joshua can start thinking, what is it forensically? What is the behaviors, the patterns? Because the black hats get smarter as you get smarter. So you put in technology, and they're not going to commit audits there or fraud there. They're going to go find the next place to commit it. So you got to stay ahead of them. Okay, that makes sense. But yeah, that's one of the problems. The PCOB needs to support this. Okay. Other comments or questions? Yeah, please interrupt me when you have questions. And I challenge you with this too. I'm learning with you guys, and I learn a lot from the class. In fact, I learn a lot from these classes about why maybe we're not doing this. And some of it is we really don't want to find this stuff. So if you disagree, I'd like you to, disagree in the class too. If you think that maybe what we're doing really is adequate, or maybe my arguments aren't, have holes in them, I'd like to learn from you too. So feel free to challenge that. This is another interesting thing here is that with the problems that are going on today with the frauds and stuff, this is from a guy, I know this guy, Patrick Taylor, he's the CEO of Oversight Systems. And he a lot of times there's a big debate going on right now of who's liable when there is a fraud in a company or a deficiency or control issue. Is it the company or is it an individual? And part of that decision is made based on how effective the internal control system was, and if it was using technology. In the case of Siemens, when we got the $1.6 billion fine, which we're not proud of at all, back 5 or 6 years ago for corruption, which was bribery. We did not get it for the bribery itself, because it's very hard to prove bribery, because you got to follow the money, and when the money goes offshore, you can't follow the money. We got it for not having an integrated, sustainable internal control process. And part of that is that you have technology in place. And one of the reasons we did a lot of the things we did is because someone stopped us in the hallway and said, are you using automation to monitor your controls? And, you know, we weren't really. And so we suddenly went out and started spending unbelievable amounts of money to put automation in, because it made sense to us. But the train already left the station. We already have a big fraud. And if you don't believe that 5% of revenue is what a fraud can cost, then take what we went through. We paid a $1.6 billion, that's a billion-dollar fine, and probably spent $2 billion more in the remediation. But that's just about 5% of revenue for one fraud that was found. And I'll guarantee you at Siemens, at Rutgers, at IBM, at HP, we're not finding this stuff. We're not finding most of it. And when we do, it makes the press and everyone jumps around, and we pass more laws that reinforce non-statistical sampling methods or regulations that don't necessarily impact it. But in this case, the Justice Department imposed a fine on an individual who admitted paying off Chinese officials as part of a real estate scam. But they went after the individual and not the company, because the company did have automation in their, they were using technology and felt that the company had a good control system that a person worked around. So having this is important for your company as well, because if you don't have it, you may be liable for the bad things that bad people do in your company. Okay? So that's important. Okay, so now we talk about traditional auditing versus continuous auditing. So let's just look at what might be different, what it might look like. So when I'm talking about this stuff, and I want you to get this idea that I'm not just talking about this for auditing. I'm talking about it for reporting, for running a business, but we're going to present it in the context of auditing. But a lot of times selling the idea requires taking a more holistic view to it, because auditing departments don't have a lot of money, but businesses do have money to invest in this stuff, and it's not that expensive. So you got the idea of what we're talking about is, instead, traditionally we observe events as part of a periodic or annual review, sometimes biannual review. So we're looking at things at different points in time. And again, the reason that CEOs and accountants commit fraud is they know when you're coming. They know you just left, and they know you're not coming back for a year. So to give you an example, if I have super user access to an SAP system, okay, and I know the auditor's coming once a year to review that system, I have the ability to shut off the logs, the security logs, to write an ABAP program in SAP that says every night when we batch accounts payable and accounts receivable, I want you to take the cents off of every transaction, and I want you to e-transfer it to my account in Geneva, Switzerland, and then turn the logs back on again, erase what I did, and do it again the next time. And you will never find it. I don't care who you are, you will never find it. But I can put technology in that reports to me, independent of the system, whenever someone does turn off or someone uses a super user access, and exactly what they do, and I can monitor that. But with super user access, I can do that in SAP, and you will never find it. I don't care how good an auditor or how many samples you take. Okay? So that's the kind of thing. So what we want to do is measure every observing events close to when they happen, so in real time. Now, real time could be every 5 seconds if it's a payment process, or immediately, or even before the payment's made by using screen technology to make sure I don't put in the wrong thing on the screen, or I can't put it in. Or it could be quarterly closing information that I'm only going to monitor at the quarter or the year end. Because what's the sense in monitoring transactions unless they happen? So the frequency is defined by the type of data. Okay? Auto-alarming when exceptions occur versus manual reporting and findings. So the other problem with auditing the way we do it today is you do the audit, then you write this report, you got managers, partners reviewing reports, and by the time the report's done, even if there is a problem, it's 10 times worse, or we didn't solve the problem. But this idea of alerting, automatic escalated alerting, okay, is really important, because that's how we're going to make sure we're going to create this perception of monitoring. We're going to stop people from doing the wrong thing, because we're going to take away opportunity. There's no escalated alerting. They know they're going to get caught. Okay, and that's the idea. And then we're doing population data instead of samples. And we talked about that earlier. Let's do the whole freaking thing. It doesn't cost much money to monitor 100,000 transactions with, and I want you to get this concept. What we're talking about here in an analytic is anything you can put into pseudocode. Okay, pseudocode is if this, then do that. Or if this, and this, then do that. And it can be a heuristic as well. It could be if a C-level executive makes or approves a journal entry for more than $10,000 at month end, or more than 5 of them. So see, I'm putting my risk thing on, because there are journal entries that a C-level executive needs to approve at month end. But if he does more than 5 of them, or he does one for more than $50,000, now send me an alert. And then if you don't get anything, you might want to tighten that up a little bit, you know, and you don't let him know that, you know, what the criterion is. But you do let people know that you're monitoring. You know? I told you earlier in the class, I'm going to monitor every one of your exams with some software to see if you're cheating, getting stuff from, you know, linguistics type software. Okay? So I want you to know that, because, you know, then you're deterred from doing. That's part of the perception of monitoring, whether I do it or not. You know, if you know I'm doing that, you're an idiot. Today, because of that disaster we had at Siemens, $1.6 billion BBB billion fine, we monitor 100 controls every day in every company in Siemens in purchase to pay through SAP. And I'll guarantee you no one's committing fraud on those. Because if you do, it goes into this automated escalated alerting, and it will be on the CFO's desk in 5 weeks if someone doesn't deal with it. And you can't get out of the loop. You didn't fix it, or there is an investigation issued around it, you can't get out of it. So no one's doing now. Are people committing fraud at other places? Sure. And that's why that's your job security. It never ends. You know, you're gonna be one step behind the smart people that are thinking. And again, people, I'd like you to think about this. In any job you've ever had, whether it was at McDonald's or teaching in a school or in a biology department or wherever you work, always ask yourself this: what could I do to steal money or steal something that no one knows about? It could be anything from taking a thing of copper and throwing it over the fence and coming back at night and picking it up and getting, you know, good money for copper, to you know, forging checks, taking petty cash, taking you know, skimming, earning. And we're going to talk a lot about fraud things that happen, but you know, people think of that and they only do it. People aren't stupid. Most people. There are a few that are, but most people only do it if they really believe they won't get caught. They have a good rationalization for doing it, to get by their faith or their convictions, and they have a motivation to do it. They need money, or they have some reason to do it. They're not paid it. So, and then integrated data across multiple and distinct processes. So that's looking at the end-to-end process, and that's the other problem we do in auditing today, is we go out and we don't look at a process end-to-end. We only audit this little piece of it. Okay. And we do our samples. You know, one of the sampling techniques is to get 70% coverage. That's kind of a big four thing. If I can get 70% coverage, so what I do is, or only category 1 entities we're going to audit this year. That means any company that doesn't have revenues of over $200 million, we're not even going to audit. So, I mean, if you know that, and you're in a company that has $50 million of revenue, you're free to. You know, no one's going to monitor what you're doing. You know, so you know, it's that kind of thing. But we want to look at end-to-end processes, because sometimes we optimize one thing and put a control in, and then it just makes another hole somewhere else. So we're not looking at the end-to-end process, and that's what automation gives you the ability to do too. And this thing that Tiffany's working on, this whole idea of process mining. If I can look at the process, I can see behavioral things in the process. And I can tell when people are doing something wrong. And then performing repeated automated tests with low variable cost. This stuff, memory's cheap, computing power is cheap. You know, this computer can do what a mainframe, you know, couldn't do just a few years ago. So, you know, it's very inexpensive. It's very expensive to fly auditors around the world to do manual tests. And I don't know how many nights I spent in airports with canceled flights, with jet lag, you know, flying all over the place. And, you know, what a waste, what a colossal waste of my time. You know? And that's what got me, is I knew from my background, I knew that this information was sitting on my computer. And now I can audit people from my home in Bradley Beach, and I do. You know, we run analytics from our homes, you know. And we still and we still travel, because there's still things you got to do. There's still tone you got to read, behavioral type of things. Okay, so, and then what's the difference between continuous auditing and continuous monitoring? This is going to be in the first chapter you're going to read too. But basically it's this, that continuous auditing is something that's an independent function done by an external or an internal auditor at the pleasure, you know, of the regulators or the system to make sure people are doing the right thing. Continuous monitoring is a management function at the pleasure of management to monitor not just compliance or regulatory things, but anything in the business. You know? And that's where this whole dovetail of, you know, the Internet of Things. And by the way, if you ever have a chance to read a great book, The Second Machine Age, by two MIT professors, it's about where we're going with this whole analytics thing. And this is the future. I mean, this is what's going to distinguish the winners and the losers in the future, is the people who know how to leverage analytics on everything that's made, you know, and to use it effectively, whether it's in financial services or auditing or making products, you know, using robotics, all that. It's all going to be about analytics. So continuous auditing, continuous monitoring, I don't make a big distinction, because, you know, I want to audit my business and I want to monitor my business, and I'm going to use the same tools and the same data to do those things. I'm just going to, one is going to be an independent function, the other is going to be a business function that, you know, anyone can do. And the way you do it, and that's the other thing, you don't use separate tools, you use the same tools. You can use the same tools to monitor a business as you use to audit a business. You just have a safe, secure portal for the auditor that's independent. Okay? So how are we doing? Oh, I need to give you guys a break. Do we give breaks in this class? Yeah, I hope so. Do it. All right, why don't we, let me just go another few minutes here, and then we'll take a nice break here. Okay? We got to get to our ACL stuff here too. So, so these are some of the things I've kind of hit on these both in my introduction and the others. So, just want to highlight a couple of them. So, what we're going to do by using technology is we're going to improve the quality of the audit. Okay, we're going to have wider coverage. We're going to be dealing with facts, and the other key thing is we can scope the audit using analytics. So, for example, what we started doing is instead of going out and doing the 3-inch thick accounts payable audit, we run analytics before we do it, and we decide, you know, that 3-way match thing, that's fine. There's no indication there's a problem there. Let's not audit that at all. And let's only do these other areas where we have some suspicion that something's not right. Or let's only do the energy group, you know, because our data is telling us there's no risk in the other group. So you can scope down an audit and yet improve the coverage. Okay? And then what you learn with your analytics, your data mining and your analytics, you give to the business then and say, here's the analytics we run, you want to run these all the time now, and you'll prevent the frauds that we were looking for. And then when we come back next year, we're not going to audit anything, because we're just going to look at your data and make sure that it's still clean. Okay? So improved audit productivity, better audit scoping, automation of audit actions, reduced traveling. This is the sort of quality of work-life thing. Preventing fraud, and that's this idea of a perception of monitoring. Someone's watching. And it's the only way to change behavior. Get away from this idea that it's only scumbags and sleazy people that do fraud. It's very respectable people in very respectable companies and institutions that commit fraud every single day. And I'd like to challenge some of you, you know, if you could steal $10,000 from Rutgers here, and you knew you would not get caught, how many would do it? Turn the camera on, then we want to get this. Okay. How about if you could steal $500,000 and you knew you wouldn't get caught? Would you do it? Come on, you guys, really?
Knew you weren't going to get caught.
You knew beyond a shadow of a doubt you were going to get caught. Let's raise the stakes. You steal $1 million from Rutgers here, and you are confident you will not.